Good morning, everybody, and welcome along to our tax and investments webinar this morning. I appreciate you all taking the time to join us on what's a dull and dreary morning here in Dublin. So just a few housekeeping bits before we get going. There is a Q&A button on Zoom that you can ask questions throughout the webinar, and I'll do my best to answer the questions during the webinar. If not, I can follow up with you afterwards. This webinar is being recorded and the slides will be made available afterwards. I'm being recorded, the slides are being recorded, but you're not. We might send you a short feedback form afterwards if that's okay. And obviously none of the contents of this webinar are official financial advice. So before we go into everything you need to know about tax and investments, just a bit about Compass. So we've four main areas. We've got private wealth, which is mainly investment management, asset allocation. We've got pensions. We advise on every single type of pension structure. Anybody here who knows me on the call knows that I'm absolutely passionate about retirement planning and pensions. So it's an area that we really do specialize in. The third one is Compass Financial Planning. That's an area we look at in terms of the holistic big picture, life insurance, consulting, succession planning. And we also do mortgages to our sister company down in Cork, my brother, sister company down in Cork, mymortgages.ie. We also do charities. So I suppose managing assets for charities, very similar in terms of the principles of investing, diversification, risk awareness, long-term investment view, all that. So Compass Charities runs its own practice specifically for charities also. These are a bit about the four of us in the business. Most of you know me on this call. Jonathan Sheehan is my name, and I set up Compass 6 years ago. I myself am tax qualified, but we don't give any sort of tax advice whatsoever. Neither me nor any of my colleagues give tax advice. We work exclusively with accountants, tax advisors, and solicitors like yourselves who have private clients and families who you wish to outsource certain needs onto, such as financial planning, pensions, investment management, asset allocation, all that type of thing. Okay, so before we go into the detail of tax, let's just look at what the distinct asset class options are for any of your clients who are looking to invest. The first basic one is cash. Even though it's not an investment per se, it is an asset class that clients can allocate capital to. So it's a very important part of a portfolio. The next one is bonds, government bonds, corporate bonds, and they can be conventional or inflation linked. What we've seen in the last while is that yields have been massively suppressed because of quantitative easing and cheap money in the market, which essentially means that the yields and the returns on government and corporate bonds is quite negligible at the moment. The 10-year return on German government bonds at the moment is minus 0.5%. Listed equities, so these are direct equities listed in the market. You can go into individual stocks, you can go into funds, ETFs, trusts, all that type of thing. Property, so an investor or client of yours can buy physical property, residential or commercial, or they can go into syndicates, or they can go into collective funds and real estate investment trusts. Private equity is something where an active investor can invest their own capital directly into private companies or through the likes of the EII scheme, which I'll touch on later on. An alternative is the word that investment advisors like me use for everything except for the previous five. And it includes things like commodities, hedge funds, absolute return funds, infrastructure investments, all that type of thing. So when a client is investing the money, then they can either go into a collective active fund, so a co-invest active fund, which is like an OIC or a CCAV or a domestic insurance company fund. They can go into a collective fund that's passively managed, like a passive low-cost ETF. They can invest directly in shares and bonds. They can also go into syndicates, SPVs, and they can go into direct investments. The purpose of this webinar this morning is just to focus on the listed investment space, okay, so just the listed space. And the first thing I'm going to speak about is capital gains tax versus exit tax treatment. So for Irish individuals, and all of you know this, so I'm not going to spend too much time on it, but there are really two distinct structures in which an investment portfolio or an investment security can be treated in terms of tax. The first is capital gains tax, where on an eventual sale, there's CGT of 33%, and there's income tax at the marginal rate on dividends. And the second is exit tax on funds, which, as you all know, is 41% at the moment. The exit tax rate, for some reason, decoupled from DIRT and from standard rate income tax a number of years ago. So 41% had been, if you remember, 3% premium. It was 23%, it went up to 33%, and now up at 41%. I'm not going to speak about bad offshore funds. That's quite technical. We don't give technical tax advice. To be honest, the vast majority of investments are in good offshore funds or domestic ETFs, domestic insurance companies, or CGT. So we're not going to speak about bad offshore funds, which have a worse tax treatment than the 41% on good offshore funds. Okay, so what is subject to capital gains tax? Okay, we know the physical properties are, we know the physical buying shares in a business and all that is. In the listed space, it's essentially individual companies and shares and real estate investment trusts and bonds, and also certain ETFs that are non-EU based. So a lot of you will be familiar with the revenue guidance that came out a few years ago, whereby they confirmed that, say, US domiciled ETFs are subject to capital gains tax as opposed to 41% exit tax. So individual shares and ETFs in certain jurisdictions are subject to CGT. And 41% exit tax, we know the domestic funds here, your Irish Life or Standard Life or Zurich, all that, and the domestic fund managers in Ireland. Also the open-ended funds, where the net asset value and it equals the share price, and where the regulation is similar to the Irish regulation here for, say, domestic funds. And they're generally Luxembourg CCAVs and UK OICs, open-ended investment companies. The vast majority of funds, as you know, are either in Dublin in Europe, in Luxembourg, or in the UK. And also ETFs that are domiciled in certain jurisdictions outside of North America. So there's a lot of ETFs here in the IFSC in Dublin and European ETFs. You always know the country of an ETF by the first two digits in the ISIN code. So IE is Ireland, LU is Luxembourg, GB is the UK, all that. Rates of tax, again, I won't spend too long on this because you know it. CGT is 33% on sale, no CGT on death. With exit tax, it's 41%, and it's chargeable on death unless there's an offset against inheritance tax, which I'll touch on in a minute. The rate of tax on income for our CGT portfolio, so for shares, it's marginal rate income tax plus USC PRSI, and exit tax, it's 41%. There is an 8-year rule with exit tax funds whereby the revenue won't allow you to roll up the value of the fund indefinitely. So I think it was 2001, they brought in the 8-year rule whereby after 8 years, if you put in 100 grand, it's worth 130,000 after 8 years, there's a 41% tax. An advantage to the CGT portfolio is that there is no 8-year rule. It's only 33% on sale if you sell it in your lifetime. Also with capital gains tax, you can offset losses in shares and that type of thing against other gains that you might have. Whereas with the exit tax regime, if you go into stockbroker A and you buy a fund in Fidelity, UK accumulating share class fund, and you lose 20 grand on that, that fund loss cannot offset against any other asset. However, what you can do is you can, if you are going the 41% route, or if your client's going the 41% route, you do it through an umbrella policy, which I'll speak about in a minute. A lot of people say, well, if US domiciled ETFs are subject to CGT, and I read the most recent Warren Buffett article and all the commentary out of the States, that's, ETFs are the way forward. But there's 3 distinct challenges with US domiciled ETFs. The first is a regulation, and this is my industry's fault, apologies for that. ETFs in the US don't produce what they call a key investor information document. So if I'm making a recommendation to a client to invest in a fund, I'll always be able to get a key investor information document through the Financial Express software we use or through the fund manager's site. And the client isn't able to invest in that on an advisory or an execution only basis unless there's a KID document available. So US domiciled ETFs, because of the legislation, can only be bought in a discretionary mandate. So you have to give a stockbroker full discretion, and that's the only way. They can't be done for investors on an execution only or an advisory basis. There's also currency cost and a currency risk. So your euro investor, you could spend up to 1% on transferring that money to dollars, and there's obviously a dollar risk as well. We've seen a significant movement in the dollar so far this year. And federal estate tax, so the legal people here would be more familiar than I am in relation to this. That's whereby US domiciled assets are held on death by an Irish or a non-US person, and the US Uncle Sam will withhold 40% above $60,000. I have personally never seen it being done. I've worked in stockbroking for 8 years before I set up Compass Private Wealth. I've never seen it being done, but they are the rules there. So it is a bit of an issue, especially for some of the individuals working for the Googles or the Facebooks or the Apples, where a significant portion of their wealth now are in shares from those US PLCs. So the likes of yourselves will be best placed to advise them in relation to mitigating that. The umbrella policies I mentioned, so an umbrella policy is basically exactly what I described, an umbrella policy with a number of sub-funds below it. And it's very, very tax efficient compared to a separate portfolio of funds, because you can switch funds within the umbrella policy. There's absolutely no tax implications. So this typical example is one of the insurance companies, you put 300,000 euros in and you could switch all day long under the umbrella policy. There's no tax implications. There's usually no cost implications either. And the kind of bid offer spread in those funds and all that is pretty much gone. Collective funds sold at a loss cannot offset against any other type of gain, whereas funds at a loss within an umbrella structure naturally offset against any other funds within the same umbrella structure. So a few tips. If an investor doesn't have CGT losses, okay, and doesn't want to hold a portfolio for life, then the CGT portfolio isn't actually a complete no-brainer. And I have a spreadsheet that I can circulate afterwards. And I have a couple of screenshots of that spreadsheet actually comparing CGT portfolio and a non-CGT portfolio. The main one is that if you're a marginal rate taxpayer, you're paying up to 50% tax on the dividends, whereas in a gross roll-up 41% fund, you're not, if you're accumulating the fund up for 8 years, you're benefiting from compounded returns, tax-free returns, and you don't have the tax obligation every single year of returning your income, which is negative from a cash flow point of view. However, if you are clear, and this is where investment advisors like me come in, frankly, is that if we look at a client and we say, okay, you're 65, you've all these other assets here, we have a portfolio here of $500,000, and you don't need that money for the rest of your life. For sure, like you definitely don't need that money, but you could do with the income because you don't have much other income, but you're not going to have to call down the capital in your lifetime. Well, in that case, the CGT portfolio makes more sense because the capital value will just roll up until their demise. So this is where kind of bespoke financial planning becomes very, very important. Generally, the way regulation has gone, if someone said, right, I want a CGT portfolio and I've got 150,000, frankly, that's very, very difficult to build because the size is below about 300 grand is thereabouts the limit. If you talk to Goldman Sachs or Barclays, it might be 5 million. Domestic stockbrokers here are kind of moving up more towards a million. We might be able to find someone for 250, 300,000 to manage a discretionary CGT portfolio. But below 300,000, it gets tricky. Now, we do training with clients. We help clients obviously on their investment portfolios. And if you set up an account with DeGiro or IG and you're trying to build your own CGT portfolio, trust me, it's a lot more complex than it seems. So that's just a challenge of, for a client of yours who is maybe PAYE and they don't do tax returns, for them to try to be a bit cute and save a bit of tax by going a CGT route for even less than $500,000, to be honest, is questionable, because they start having to filing tax returns, they get tax statements. You know, it's a big ask, and I'm not so sure would I recommend it. If you do have US domiciled assets, it may not be possible to sell them because you might have a big CGT gain. So obviously the tax and legal people here would have a better idea, but perhaps if they were assigned to a beneficiary who has CAT liability, that would be more, because that can offset against the federal estate tax. Fees. Okay, well, fees can be extremely tax inefficient or tax efficient. Types of fees. The annual management fee in a portfolio, say via stockbroker, which is usually 1%, it can be 1.25%, or it could be as low as 0.75%, which is vatable. Second one is buying and selling commissions. That's less popular now than it had been a few years back. I would rarely ever give a mandate on behalf of one of my clients to a portfolio if they're having large buying and selling commissions. Foreign exchange costs, the hidden stealth. The regulations don't make investment firms disclose the exact amount of foreign exchange margin or commission, so there's a huge loss in fees with foreign exchange, stamp duty and other transactional charges, and then the internal AMC of the collective fund. So often you have a portfolio, 1% plus VAT, and then you've got all these other funds. We'll talk about that in a minute, and you'll get my point on how bad that is later in the presentation. Challenges are, your private clients can't write off the 1% plus VAT management fee on a non-pension portfolio, and they can't reclaim the VAT either. So firstly, fees should always be weighted towards a pension, first and foremost, because a pension is a pre-tax pot of funds, so it's more tax efficient by default. Remember, internal management fees are not subject to VAT, so fees incurred from within the fund also reduce future exit tax or CGT. So that's more tax efficient than paying a 1% plus VAT at portfolio level as opposed to fund level, because if it's incurred at fund level, then it comes out of the value of the fund, thereby reducing your future tax. Ironically, commissions are actually very tax efficient for either an investment firm or, frankly, an intermediary like us, because they're not subject to VAT. For buying and selling, it actually increases the base cost and decreases their disposal value. And intermediary commissions from non-vatable funds. So if an intermediary receives a commission, the tax treatment of that is the same as what the fund management fee is treated from a VAT point of view, which is non-vatable, so our fees are non-vatable. So it's a kind of a win-win for the client. Need to be careful that clients and your clients their interests are aligned with that of the investment professional, so that you don't just look at it from a fee point of view and give a mandate for a discretionary portfolio with 1% commission on buying and selling because it's more tax efficient, yet, so you can put limits on it. We do that with our clients. Vatable portfolio management fees and a non-pension portfolio can be a huge cost in this low interest rate environment. I'm now saying to clients, look, we're getting negative interest on deposit. If you can get a 3%, 3.5% gross return from a medium risk portfolio, that's actually very good. Now, if you're paying 1.25% plus VAT away on fees, and then all the other collective funds, you're actually moving forward to stand still. Even with a 2.5% gross return every year, you could actually be losing money. So that's kind of our job, to be honest, to get under the bonnet on fees on behalf of our clients. Pensions, the most tax efficient way of fees being dispersed. Tax compliance. Now, the timing of this webinar, whatever, the 18th of November, hopefully your clients didn't hear about the 10th of December tax return extension and have done their tax returns, so you can look forward to Christmas without that. But for those who haven't done their tax returns, and maybe I should have had this webinar a couple of weeks previously, as you know, when your clients purchase offshore funds, the details of the purchase need to be disclosed. This is the page from the Revenue Online, which I pulled from my own ROS just last week. So there's a lot of information there, and it's gathering the information I find is the most difficult thing. It's also very difficult for the client to self-assess for the exit tax. Now, most people, thankfully, markets have been strong, other than the blip earlier this year, will be in a positive position from funds they previously purchased. So it's incumbent on the investor to self-assess for the 41% gain after 8 years. And the stockbroker or the platform, they do not, I'm telling you now, they do not see it as their responsibility to remind clients, by the way, Joe Blogs, you purchased a fund in 2012 for 100 grand, it's now worth 150 grand, it's a Luxie Cav. We suggest that you tell your accountant so that you pay 41% of the tax. It just doesn't happen. The good thing about the domestic insurance companies is that they do that for you. They do actually just pay the 41% at source and just send you off, unless you have a non-resident declaration. So stockbrokers should provide 3 different reports per annum. Okay, the first is an annual tax statement, which is early in the year for the previous calendar year. A CGT statement in early December for the first 11 months of the year. So you should all be getting that in the first couple of weeks of December for the year to 30th November, and then another one in January for the previous month, for the previous December, yeah. Now, a lot of stockbroking firms in Ireland are UK companies with Irish offices, which is, there's nothing wrong with that. And in fact, a lot of them have moved their European base to Ireland to prepare for Brexit. And some of them also use an international custodian, the main one being Pershing, which is Pershing 100% owned by Bank of New York Mellon. So I think about half the firm stockbrokers in Ireland use Pershing. But the quality of tax reporting is terrible in Ireland, okay? Some firms are better than others, but there's just a pure lack of consistency. So those doing compliance tax returns here, I can feel your pain. And I know they're nonsense and they're very difficult to get your head around. They do not make it clear if an investment is good offshore, bad offshore, if it's an investment trust, which is like an individual company, but might be defined as a collective or some sort. They mightn't distinguish what an ETF is. A lot of the investment firms don't give the address of the offshore fund, which is crazy to think about it. So the tax advisor, the client has to go off and sometimes use Google, unless they've got an advisor like us we have all this information on file. They need to find the address of where this Fidelity or this Threadneedle fund is, what street it is on in Luxembourg, literally that kind of detail. You have to go on the prospectus sometimes because investment firms may not provide it. This is a huge issue that I only discovered last week. When a portfolio gets transferred in specie from one provider to another, oftentimes the new provider will reflect the book cost at the date at which they received custody. So say a portfolio is worth €1 million and it transferred from stockbroker A to stockbroker B because a certain guy moved companies and convinced the client to move with them. Happens all the time. In that case, the receiving stockbroker should reflect the same book cost that the original stockbroker had. But to be fair to them, their point is that they can't. How can they rely on the initial book cost without seeing contract notes, that type of thing? So this is a really, really important area that I'd suggest that when you're doing CGT returns and things like that you make sure the book cost correlates with the initial actual contract note they should have in file. Also, if a big investor, so a lot of our big clients, they deal with 5 or 6 or sometimes 10 different managers, and we consolidate all their valuations. So it's easy when they deal with us as an overarching asset allocator, fund manager. But a lot of these people, they deal with 3 or 4 different investment firms. And in fact, one investment firm could be buying Apple one day, and the next day, a different investment firm sells Apple for that same client. So that's a CGT gain, even though they're different stockbrokers. So that's another issue. Now, this would only affect the ultra kind of the higher net worth clients. From your point of view, it's probably something you can have conversations with them about to make sure that it's all consolidated. There's nothing wrong with dealing with different providers, but they need to be consistent from a tax point of view. Big issue is there's no automatic reminder for the 8-year anniversary. Tax statements, different formats. They show the gross income, withholding tax, net income. There's a number of anomalies. North American ETFs can be categorized as overseas unit trusts, so some might think they're 41%. Ireland is actually often referred to as overseas because it's a UK-based investment tax report. And I know that for a fact that some of the low-cost online platforms, so it's great. I mean, I'm not sure what Revolut is like now, but Giro and IG, they look great and they've got all the lovely prices and all that type of thing. But if someone's investing big money on them, the quality of their Irish tax reporting is negligible. So conclusion, an investor should put all their non-pension investments into an umbrella fund. It's actually the easiest way from a tax point of view, from a compliance point of view. They should never give money to an investment manager without clarity on tax. And we need to make sure that some of the same investments aren't being bought and sold by different managers at the same time. And from your point of view, frankly, it is an opportunity to work with clients more closely and ourselves to do investment and tax audits to make sure that their portfolios are overseen, to make sure that 41% tax has been correctly filed. Okay, so reducing capital taxes. Section 72 policy, yes, it's a life insurance policy, but it is actually as much of an investment policy as a life policy. So it's a very clever way of investing money through regular premiums for the next generation to save on inheritance tax. So it's a life policy with a fixed sum assured for a fixed monthly premium. And as long as these policy premiums are made, the policy pays out a lump sum to the policyholder on their death if it's a sole policy, or on the death of the second spouse if it's a joint life last survivor. The client does have to do a medical, so anybody who has serious health issues, this would not be appropriate for, because the insurance company will either turn down cover, refuse to quote, or frankly load them to the extent where it would be too expensive. Investment planning, it is a really good investment vehicle in certain cases. And the distinct advantage, as you know, is that the proceeds of a Section 72 policy are tax-free as long as they're used to pay inheritance tax in the same 12-month period. So we actually have a separate webinar done before on these types of policies, so reach out for more details on Section 72. I wasn't going to include them in this, but actually I realized it is actually an investment policy as such, so it's very important. It also covers a special 30% rate on ARF income tax when inherited by a beneficiary over the age of 21. So a lot of people don't know that with Section 72. So sometimes a client has an ARF at 1.5 million. There's going to be 30% tax on that, 450,000. So they might just set up a Section 72 policy to cover the 450,000 tax and use the imputed distribution of the ARF to fund the premium on the Section 72 policy. We can provide quotes at any stage. All we need is a date of birth and the sum assured, and that's all we need for a quote. Section 73 is similar in that it reduces capital taxes, but it covers gift tax as opposed to inheritance tax. It's basically a regular premium investment policy, has to be with an insurance company, endorsed as Section 73. So for all intents and purposes, it's just like a savings fund. We set these up for clients all the time, and a lot of the time we don't even tell them about the Section 73 because frankly it can confuse things. But we get it endorsed by the insurance company. We generally use Irish Life for these policies, and then we have the option without the obligation to use it for Section 73 purposes. It is very difficult to plan 8 years ahead. With a Section 72, you need to be sure, I'm going to use it, I'm going to pay this the rest of my life. Whereas Section 73 policy, you can change your mind after a year, 3 years, 5 years, 7 years. You don't even have to go to 8 years. But after 8 years, the proceeds can be gifted to a third party and they're free of tax, 33% gift tax, as long as in the same 12-month period, the same beneficiary has gift tax payable. So you guys know more about the tax side of it than I do here, but the point is that a Section 73 regular premium policy is very, very important and relevant in certain cases. Differences between the two: Section 72 is an insurance policy, Section 73 is savings. Essentially, a Section 73 is a savings policy, and you choose an investment fund and it forms part of your portfolio. They're not just tax savers. I mean, Section 72 will still pay out a lump sum whether or not there's inheritance tax to pay or not. And a Section 73 is a great way to average money into the market as part of an overall investment portfolio with the option to use for Section 73 purposes. Small gift exemption, very clever thing to do. It's part of an overall portfolio. One drawback is that kids or grandkids, the grandparents or the parents don't want to just gift them €6,000 cash into their account every year, 6,000 if it's a couple, for behavioural reasons. Okay, they lose the value of money, all that type of thing. So setting up a portfolio of different investment accounts for beneficiaries is actually a very clever way of gifting the 6,000 in. So we've done that for clients. We do that for clients where there might be 10 beneficiaries. We set up 10 policies, all with one insurance company at once. They have a pre-written bare trust there, and £6,000 a year goes into them. And you know, the beneficiary, if they're under 18, it's a bare trust. If they're over 18, it's just an investment account. They can technically, legally ring me up and say, you know, give me my 6,000 back or whatever the value is. But they 9 times out of 10 they won't, because it's kind of off balance sheet, if that makes sense. So the £3,000 small gift exemption is such a useful thing to use for those with a lot of dependents below them. In this case, 4 married children, so 8 below them, 10 grandchildren below them. They can actually give 108,000 each year to the next generation. What I say to clients now is, we're in November, 108 by 2, it's 216,000. Make 108,000 contribution in December, and another 108 in December, or in January 2021, and then you're done with it until December 2022. So again, just some summary tips. 41% exit tax is chargeable on death, unless there's CAT to offset that. But for married couples, make sure, don't ever have it in a joint sole name, have the account in a joint name, and 2 lives assured on the policy. Use a small gift exemption, use Section 72 or 73. Okay, so we've one more section left. We've 5 more minutes, so I'll rush through it, and we'll have time for a couple of questions then at the end. Pensions, again, anybody who knows about me knows I'm absolutely passionate about pensions. They just make so much sense. Contributions can only be made against earned income, as you know. Employees and directors can receive employer and employee contributions, but the unincorporated self-employed can only make employee contributions. These are the age-based limits, the earning ceiling of 115,000. Note, employer contributions, unless it's to a PRSA, but employer contributions to a group scheme or an executive pension don't count towards these age-based limits. Proprietary directors have huge scope for funding because of back service. We can create actuarial calculations for large single contributions. Depending on their age, their pension retirement age, we always bring that as close to 60 as possible. You can always change it back to 70 if you want it. The pension retirement age actually is meaningless. You reduce to 60 to increase the funding, and you can move it back up the following week if you want. It depends on their existing pension fund value. So someone on a generous high salary in the 6 figures who runs their own business with only 100,000 in pension and they're age 50 has enormous scope to fund the pension through large single contributions. And their current salary and their years of service will also add to it. So we can carry out these calculations. My colleague Angela, who's on the call here as well, could tell you better, but it takes us about a day to turn around the max funding calculations. And we don't charge our partners, our accountants and tax advisors and solicitors who refer clients to us for that service. Yeah, with pensions, and again, this is all in the context of investing. You get tax relief going in. Employers get tax relief at 52% ultimately, because there's exemption from PRSI and USC. You get tax-free growth. There's no CGT, no exit tax, no income tax. The pension threshold is actually 2.15 million because of an offset between 40% tax on the excess above 2 million and the lump sum on the 25%. Tax coming out, 25% lump sum, the first 200 of which is tax-free. 75% goes to an ARF. First 63.5 goes to an AMRF. Very, very importantly, by the way, how they think of it, if a client receives the full state pension at 67 now, 66 or 67, they no longer can have an AMRF. They can have an AMRF, but they now need to take the 4% imputed distribution from it. So just watch that for your clients, because you need an AMRF unless your income is below 12,700 per annum. So what happened is that they increased the state pension, the full contributory state pension, to above 12,700. So ironically, before the AMRF was untouched until you're 75, now it's actually from full state pension age. So watch that, because if they're not paying tax on it, there should be an imputed distribution. On death, the ARF goes to spouse tax-free, and it goes to individuals over 21 at a flat 30% income tax rate on death of the second spouse. Pension versus personal investments. A pension fund will grow about 30% faster than a personal investment fund because there's no taxes slowed down. So when your clients are investing, prioritize pensions first and foremost. I tell a lot of people, unless you're maxing your pension contributions every year, you shouldn't be investing any money personally. Unless your funding is maxed out, then invest money personally. EII investments, the rules have changed recently, so you get tax relief of 40%. Tax relief can be claimed against all income, so it's very relevant for someone who's got large rental income, for example. The allowable amount is $250,000 for a minimum of 4 years. Just be careful with the EII investments, because you're getting the tax relief for a reason. Those companies could go to a bank if they are more secure and stable, frankly. So you are benefiting state aid because you're investing in Indigenous Irish companies. And so you are taking more risk, and that's why you're getting the 40%. So it's like you're investing 60 for every 100 that goes in. And a direct investment does come with specific risk. Personally, I always use a fund of different companies, because it just kind of removes company-specific risk. Okay, a couple of minutes for case studies. I see a couple of questions coming in. You can be, I'll be checking them in a minute, so keep those questions coming through the Q&A tab. Life policies at 41% are more tax efficient than one would think, because the fees are more tax deductible. They don't incur VAT. The value of the fund will roll up for 8 years if it's an accumulating share class. The accrued income is ultimately taxed at 41%, as to potentially a higher rate if the individual is paying marginal rate income tax, which could be whatever up to 50%. There's no annual tax return requirements with a life policy wrapped fund. Fees can be more competitive due to less fee layering. And with an umbrella policy, you don't have buy and sell tax implications. So again, if you are talking to a client about examining their overall portfolio, really you have to look at their specific circumstances. If they're paying standard rate income tax, and if they want to hold a portfolio for life, then maybe CGT portfolio is better, or if they have CGT losses. But in a lot of other cases, especially for amounts less than $500,000, the 41% tax regime actually isn't bad. Big value in simplicity. So this time of year, people should be selling down small bits of shares to use the 1270 threshold. If a fund is held below cost, ironically, that's the most tax efficient way of holding it, because yes, you've lost money, but the growth back up to base cost is actually very tax efficient. If an investor is a few years into an offshore fund and it's kind of around the base cost, then actually they could sell it and then buy a similar fund instrument. Probably have to be careful with revenue, but around the same time, so that you're restarting the 8-year clock. It's just something small that can be done. Audits should be carried out to make sure that the 41% and that all the tax reliefs are used. Also, we need to make sure that investors don't lose dividend withholding tax that isn't being claimed back through a portfolio. It's something we look at as well. So also, let's assume somebody has future exit tax due, say they're 6 years into an offshore fund tax, a big portfolio to one of the big stockbrokers. They have surplus liquidity. They have children or beneficiaries who have the group threshold capped out. You can actually look at gifting the shares in the offshore funds, crystallizing the 41% tax, but also offsetting that against the 33% gift tax. And actually, in practice, this is done through an in-specie transfer within the same stockbroker. So we would set up an investment account in the child's names or the family partnership if there's a few beneficiaries in a partnership structure, and you simply transfer the holdings in the fund in specie from the parents to the children, the beneficiaries, and hold it for 2 years to avoid a clawback. And remember, what we do is we make sure that the stockbroker doesn't charge a hefty 1% plus VAT management fee on the children's accounts, because no activity can happen because the funds have to stay there for 2 years. I'll send the spreadsheet on to you afterwards. This is just, or contact me if you want the spreadsheet. This just compares a share portfolio versus life company funds. The same 6% return, but I put in the share portfolio VAT and the fees and the non-tax deductibility of it. And the end of it here, ultimately the life company after 8 years, it will be 128,000 versus 122,500. So in this case, a life company will be 6,000 more profitable for the client, assuming they're looking to sell after 8 years. Now, if there's one thing to take away from this highly exciting webinar, I'm sure, is please, if you see this type of portfolio, tell your client or ring me or do something about it, okay? The most tax inefficient investment portfolio possibly is a non-pension portfolio with a high annual management charge of, say, 1% plus VAT, populated with all these third-party funds. Frankly, the stockbroking model is a bit broken in Ireland. Instead of them buying individual shares and doing the research on stocks, a lot of them are outsourcing fund management to all these clever fund managers in Luxembourg and the UK and New York and places that are just, it's another collective fund with another set of fees. So third-party collective funds, then those funds themselves are actively traded. So we sold out of 20% of this iShares fund and bought X amount of this Fidelity fund or this Jupiter fund or whatever it is. That actively trading creates a minefield for reporting. And then when the quality of the reporting is poor and they don't disclose the address of offshore funds, or a lot of the time the book cost isn't correctly reflected, that's an alarm bell for tax inefficiency. So clients should not have that type of portfolio. That's it. Thank you for bearing with me. We're just over the 40 minutes. So I have a couple of questions here. First one here is, have you a view on an age by which a client should commence Section 72 policy? I would say the minimum is 50, more closer to 55, and probably the maximum is 70. Unfortunately, as time goes on, I've talked to people about Section 72 policies who may be 60 now, and I'd say, oh, you talked to me about that 3 years ago and I didn't do it. And now I'm thinking of doing it. So technically I saved 3 years of premiums. You say, yes, in hindsight you did, but actually, unfortunately, you do run the risk of getting sick all the time, and these insurance companies will go through everything with a fine-tooth comb. So while somebody is healthy below the age of maybe 60 or 65, it's the opportune time to lock into a fixed premium now for life that will never change. Just on the Section 72, you probably heard a lot about these reviewable whole of life policies, whereby someone has an Irish life policy from 25 years ago and they're getting a letter now saying, it's now the anniversary date and your premium is staying the same, or your sum assured is going down, or your sum assured stays the same and your premium goes up. Those type of reviewable policies are very, very difficult to handle from a cash flow planning point of view. So what I would say with them is they don't exist anymore. So if you're signing up to a Section 72 policy, it's guaranteed for life. Another question here is talking about how you liaise with the stockbroker in terms of a tax efficient portfolio. Well, the answer to that is it's easier if it's fresh capital to come in. So when we do RFPs for on behalf of clients, we do beauty parades. It's up there with past performance and model portfolio and all that type of thing. Is what are the tax implications? So it's frankly my role to make sure I understand the tax implications of the client, and I speak to you guys as the accountants or tax advisors. So it's easy with fresh capital, okay? But when it's an existing portfolio, it becomes more tricky because the portfolio is already invested. But it is very important then to say, okay, I'm drawing a line in the sand and we're ceasing the portfolio, get a consolidated valuation as at the 18th of November, not just for portfolio A, but for all of the portfolios. And we're doing a holistic view on everything. And we look at the tax implications of everything, and it's both backward looking to make sure everything's done from a compliance point of view, but forward looking as well. So that will add a lot of value to clients. And frankly, speaking as an ex-stockbroker, stockbrokers do get it, like they do understand it, but they're afraid to proactively deal with this with clients because they know their knowledge is limited and they don't want to be saying something they shouldn't. So they just say, well, we're the investment people, we have the investment hat on, and you get your own tax advice. But really looking at it from a tax point of view is arguably just as important as anything else. So guys, that's it. Thank you very much for listening. There is an upcoming webinar. I'm delighted to announce, as of yesterday, we secured Michael McGrath, TD, Minister for Public Expenditure. He is speaking at a webinar on the 11th of December. So it's going to be specifically for our clients and for professional advisors like yourselves. I'm telling you now because I will be inviting everybody in this call, and I plead with you to send me questions in advance. It's going to be a simple Q&A between me and Michael McGrath, fellow Cork man, obviously. So please do, you're more than welcome to attend that. I'll send out the invites. Do think of Compass when you have clients, when you're having discussions with clients, both from a reactive point of view, if clients are asking questions. We'd be delighted to hear from any referrals. We'll meet anybody for a virtual cup of coffee at no charge. Our whole business model is based around professional advisors like yourself, so please do reach out. But also, you know, when you're speaking to clients, maybe use some of the content from today to talk about some of the planning opportunities that come with tax and investment management. Thank you again, everybody. I'll send on the slides and the feedback form afterwards. I'll also send you an invitation for the Michael McGrath webinar. Take care. Thank you.